Hey everyone, John Henry here, Slingshot Futures Trading Group, SSFTG. Welcome to the video. In this one, we're going to be taking a look at striking while the iron's hot. There are times during our trading careers where the market simply moves too fast. You try to get an entry and you miss the fill by just a second, or it doesn't quite make it to your limit order by a tick or two, just to reverse right back in the direction that you were expecting it. When the market presents a setup or an opportunity, we are assumably already prepared for it, right? So as long as that assumption is true, we must strike while the opportunity is there to take the trade before you miss it to tricks and traps. Hesitation is the killer on this one, and if you hesitate while you're in the zone, or when you're in your zone of interest, there are likely two primary reasons. The first reason is that you're risking too much on your account for the trade, but you don't want to admit it to yourself. That's called ego. Or you don't trust your trading system, which is just doubt. Now, first off, you should have your risk locked in before you even thought about clicking the button. If you didn't, that's why you're hesitating. You have no idea what your risk is. How could you ever be comfortable getting into a trade? Now, always ensure that you're never risking more than 5% on any trade, if at all possible, but preferably the lower that percentage, the better. I like seeing half of 1%, but it depends on your account size, and what's reasonable for you might not be necessarily reasonable for somebody else. So there is a little bit of a personality that comes to it. Now, secondly, the other side of things is you're just not trusting your trading system, and a lot of times it just comes down to a lack of experience or inexperience with a system. You haven't had enough screen time with it yet to fully understand how it operates and what to expect. And that's why sim accounts exist. You can't ever hope to nail down a strategy without practicing it first. Just like any other profession, it requires practice, study, and time. So let's jump back to the example of risk, and let's say for a second that with this giant move to the downside, I want to be a seller. But while realistically, where am I going to be a seller at? Now, I don't necessarily know where, but I know given the way that this looks, just making things easy, we've got a nice structured high above here. We've got another previous major swing up here. So that looks like a viable location. If I wanted to short, I could sell right above this high. I'm not saying it's a reasonable trade or that it's good, but just putting it out there as a way to look at this trade and say, okay, if I wanted to take this trade, where does my risk have to go? I have to know that before I click the enter button. Where is my risk? Well, if I'm going to be entering short here, realistically, the only spot that would make sense for my risk would be above these highs. And if my stop is going to be above the highs, I can't realistically go for a 2-to-1 because that's way down here. That's below the lows. So the only type of trader that I could be if I were going to be shorting this area would be a scalper. And that means that I've got to go for at least a 0.5-to-1. If I want to be a swing trader, my entry has to be better. And maybe that means that I have to wait for price action. But as an example, if I get an entry that's a little bit better up in the 15,335s, I now have a 2-to-1 objective that fits into the downside. But you have to be okay with the other side of it, right? It's great that that's where my risk is, but really look at it and say, okay, am I okay losing $61.50 on this trade? Less commissions on both sides, you figure closer to $67 to $70. Am I okay losing $70 on this trade? Is it worth it? And you really have to ask yourself, as soon as you enter into the trade, assume that money's gone and ask yourself, am I okay with that money being gone? I just made that purchase and it cost me $61.50. Now my job is to sell it back for $123 and bank the difference. That's one way to look at it so that it's a zero-sum game. The money's already left your account where you placed your stop. That's your risk. And that's really the big factor, looking at it and saying, okay, am I willing to risk that $61.50? And if I'm not, if that doesn't fit into my plan, then I have to approach this in a different way. As an example, a $61.50 at a 5% risk would be a $1,230 account. So if you're trading on like a $700 account as an example, that's not going to fit the budget. You got to wait for something that fits, and if you are taking this trade anyway, you're probably going to find psychological barriers, hesitations, weaknesses, issues along the way, trouble managing it because you're above your risk perception, what you should be taking on the trade. And then again, the other side of things is just trusting your system, and that comes down to understanding probabilities and edges. We don't have to have a huge edge for long-term probabilities if you're going for 2-to-1s. Remember, in the long-term math, if you're accurate 39% of the time, 39% of the time, but your reward is twice the size of your loss, your trader's math at the end is well over 1,000. It's incredible. So the trader's math number for that doesn't require a huge accuracy, but the important part is that you wait for that larger target to actually hit, and you gain a bit more experience of allowing the trade to do its thing by managing the trade and exiting early and jumping in late and jumping in too early and all of these other things. You're not familiarizing yourself with the setup or the strategy. You're familiarizing yourself with like a customized, aggressive variation of the strategy. You can't hope to nail it down if you're not going to at least give it the time of day. So study, practice, time, use the sim account, study, practice, time, over and over and over again until you really have that confidence to move over into the live account. And remember, when you move into the live account, you're going to have to reintroduce yourself to that brick wall of psychological emotions. It's easy to get rid of psychological emotions when you're talking sim account because it's not real money. And I don't care how much emphasis you put on it, it's easy to get rid of the psychological impact because it's not real. But when you're dealing with real money, all of a sudden those walls creep up and you've got to work your way through them. And if you find that you're having difficulty, you take a step back, right? And reevaluate. How's my trader's math? Am I approaching things correctly? Am I still following my trade plan, or am I getting psychological again? And you really have to reevaluate. It's sticking to the pattern and sticking to the setup and the strategy. Practice, study, time. I can't say it enough. That's going to do it for this one, though. Hopefully you found it useful, interesting, entertaining, and maybe something you can add to your tool belt. As always, if you have any questions, you can drop those in the comments below, or if you have a more detailed question, shoot me an email, jhb@ssftg.com. Until the next one, enjoy, rest up, and we'll see you all then. Thanks.